Spirit Airlines is preparing to shut down. With its stock down 70% and 17,000 jobs on the line, the model that once democratized air travel is disappearing from the skies. Wall Street analysts look at the ledger and see a standard story: debt maturity walls, sudden fuel spikes, and blocked mergers. These financial metrics are merely lagging indicators of a deeper failure. Spirit crashed because it was operating with total structural blindness. Spirit built itself as the ultimate corporate renter. It avoided physical anchors, no massive legacy hubs or concrete poured for decades. Instead, its model relied on being asset-light, migrating wherever demand was cheap and costs were low. This agility is the mathematically rational goal of every modern enterprise, from ultra-low-cost carriers to digital startups. Spirit optimized its business perfectly against the data it had. But perfect optimization is fatal when the data points are hallucinations. Any healthy economy depends on a division of labor, a dynamic equilibrium between two distinct forces. On one side are the renters. These are mobile engines like Spirit or OpenAI that provide market liquidity and high-frequency sensing of where people are moving and what they consume. On the other side are the indigenous anchors. These are the municipal airports, regional grids, and hyperscale data centers. They provide the physical scale and the stability of 30-year bonds. Renters prioritize velocity and agility. Anchors provide the capacity and the physical foundation. The system breaks because these two forces have no mathematical way to speak to each other. The digital algorithms used by the renter and the physical concrete poured by the anchor exist in isolation, with no shared protocol to verify the truth of the market. Without that shared language, the renter flies blind, and the anchor is left holding billions in stranded infrastructure when the market foundation cracks. To navigate, mobile enterprises rely entirely on statistical averages of regional demand. They make multi-million-dollar bets based on what the average consumer did last year. But an average cannot see a systemic shock. It misses the geopolitical spike or the local economy that is quietly softening beneath the surface. This blindness stems from fragmented identity. A corporate ledger tracks a human in one dimension, a passenger, but they are also a ratepayer, absorbing a 40% utility spike, and a commuter on failing transit. Drowning in localized inflation, they've stopped discretionary spending to survive. When ticket sales drop, the airline's AI assumes the problem is pricing. It slashes fares and burns through its cash reserves to chase a customer who no longer has the capacity to participate in the market. The company is destroying its own balance sheet to chase an anchoring phantom, a statistical average that doesn't exist in the physical economy. Currently, the internet operates on two layers. Layer 1 moves atoms, planes, and power lines. Layer 2 moves bits, algorithms, and databases. But there's a void between them, where market truth is lost. We need a third layer, a completion layer designed to provide cryptographically attested ground truth by connecting the digital assumptions of the boardroom to the physical reality of the community. Through a cryptographic audit, an enterprise tests its assumptions. It pushes a query to a regional mesh. Our models assume this community has discretionary income, true or false. Individuals evaluate the query against their reality, responding anonymously via secure edge devices. The architecture ensures the mass hides the individual. No personally identifiable data ever leaves the user's phone, protecting privacy while revealing the state of the market. This shifts corporate strategy from extracting personal data to verifying the actual foundation of the market. When a clinical 67% consensus is reached, the enterprise achieves ground truth coherence, the point where corporate data meets verified physical reality. This allows the CFO to initiate a parallel treasury execution, independently releasing trapped capital reserves and moving them from phantom demand to areas where demand actually exists. This isn't just about airlines. The tech industry is currently pouring $660 billion into AI infrastructure. They are acting like ultra-low-cost carriers, optimizing for averages that have never been audited against the physical foundation of the market. For any CEO, restructuring debt or buying more compute power is useless if you are flying blind. The only question that matters is how you audit your averages. Agility without ground truth ensures that companies will continue to crash into invisible market fractures. Spirit Airlines may be the first to fall, but the pattern will repeat until we build the layer that lets us see the truth.